Very warm welcome to 10lessons.net and the Trading Mentor. This today is lesson 9, a correlation of markets. Before we go on, just a quick disclaimer. We do not offer any advice at any time. All the information that we offer is educational only. So lesson 9, correlation within markets is a very, very important thing to understand in order to maximize your profits and minimize your losses. Why it's important, we cover that, and how to use it effectively. The book did explain a few bits and bobs, didn't it? Hopefully that was understood. But this short video will give a clear understanding of how different pairs correlate with each other. And in this example, if the stock moves up, then the New Zealand US dollar moves up, Aussie USD, Euro Yen, Canadian Yen moves up, and then these currencies move down. Euro Aussie, US Canadian, Pound Aussie. This is a more detailed example of what happened with gold, oil, US dollar and equity. So these are good pairs to have. For instance, with gold, when gold is going up, then Aussie USD goes up, New Zealand USD goes up, US Swiss. Now with the Aussie USD and the New Zealand USD, you don't want to be holding both because they pretty much do the same thing. If you hold both, you're doubling your risk. Similar with oil, Canadian Yen does well, Euro Canadian and US Canadian correlate with oil. US dollar, currency is Euro dollar, US Swiss, Pound USD, equities, Pound Yen, Euro Yen, US Yen. So these are very good ways of calculating your risk at outset. How does your new position correlate with others? And is there a chance that, hold on a sec, if two of these currencies are doing the same thing and they shouldn't be, then that's a good time just to think twice. A short video today in lesson 9, but nonetheless a very important one. Get to know it during my video sessions, my video updates each day. We will be looking at correlation on a regular basis, so don't worry if you don't quite get it yet. We will repeat these sessions during the live sessions in the market.